The next standard we have is standard 5, which is talking about investment analysis, recommendation, and action. Now, this term analysis, recommendation, and action, this basically includes all of your professional activities. And because it is going to repeat multiple times, instead of writing all these terms together again and again, I'll simply be using this abbreviation from here on onwards. So let's look at the standard 5A, which is diligence and reasonable basis. This standard is very basic in terms of what it is trying to convey out there. So let's look at the content of the standard. It is saying to exercise diligence, independence, and thoroughness when you, as a member or a candidate, are doing some sort of investment analysis, recommendation, or you are taking any actions. So, diligence, independence, and thoroughness. In simple words, be aware, make sure you are working hard, you're working at the correct analysis, and you are using all the possible input resources that you can to make sure the analysis work is correct. Be independent, don't be influenced by outside biases, and you should also be thorough. So make sure you're using all the available information that is out there and you are using it in a lot more detail than just looking at it and thinking of it on the face value. So one basic example could be, let's say I'm analyzing income statements of a company. Thoroughness would include not only analyzing income statements but also looking at corresponding notes to accounts and all the relevant disclosures given there. So diligence, independence, and thoroughness. Now the next part is talking about that when you do the analysis, recommendation, and actions, you should have a reasonable and adequate basis to support whatever decision you've done, along with relevant to research and investigation. So basically, any sort of analysis, any research work, any recommendation, any action that you take, you should have a proper justification for what was the basis of taking that particular decision. What was the basis of taking an action? What is the basis on which you have given any sort of recommendation? Now, the word reasonable has been used here, which suggests that there is some sort of a subjective element in deciding whether or not the analysis and the research work done is it adequate or not. So there is no absolute limit specified in the standard whatsoever. So at the end of the day, the decision as to whether the analysis, whether the research work, whether the investigation is it adequate or not, that is a subjective one, and if brought under question, the member or candidate must be able to have justification for the same. So that's it for standard 5A, very basic. Let's move on to 5B. The next standard we have is 5B, which is talking about communication with clients and prospective clients. Let me clarify right away. When it says communication, it includes all sorts of communication, whether written, whether oral, email, telephonic, all of them are covered within the purview of the standard. So let's get right into it. Firstly, it requires you to disclose the basic format and principles of investment process and any changes therein. So basically, when you are, doing some sort of research work, some analysis, you would be following some sort of investment process. That process could be one that you follow, individually, or it could also be a process that is followed by your firm in case you are in some sort of an employment. Now, the standard requires that if any particular investment process is being followed, you're supposed to disclose to the client the format and principles associated with it so that he is able to judge for himself as to how thorough or how accurate that particular investment process has the potential to be. Aside from that, you are also supposed to communicate any changes that happen to the investment process itself on a very prompt basis. Now, this part would also include situations where you are using some sort of a financial model. Well, in that financial model, you are supposed to disclose all its limitations, all its assumptions to the client as well, so that the client is able to judge for himself as to how reliable that model is going to be in certain situations, probably in the extreme risky situations. Aside from that, if you are using some sort of a pro forma financial projections, in my analysis what I did is I looked at the past data and then I projected the future data. That future data has to be projected based on some assumptions. Those will also have to be covered within the purview of the standard. Now, the next part we have is to disclose the limitations and risks associated with the investment process. Now, the investment process might not work outright in certain situations, something like, let's say, extreme economic depression. So those limitations of my investment process have to be communicated along with any risks which are inherent to the investment process itself. Now, aside from this, it also says use reasonable judgment. Again, the word reasonable has been used. So this is subjective. It could vary from one person to the other. So you're supposed to use reasonable judgment to identify factors relevant to your analysis, recommendation, and actions. So now it is talking about identifying factors relevant to the recommendations that you are doing. So let's say I recommend a stock. Let's say I'm working on an analysis, or I'm providing some recommendation on a particular stock that operates in oil and gas industry. Now they will have extreme sensitivity to the global crude oil prices. This factor is relevant to the recommendation I'm giving. So it might not be relevant to the entire process that I follow, but it is relevant to the recommendation that I'm giving. These factors also need to be identified and communicated with the clients. Lastly, we have a requirement to distinguish between facts and opinions. So any past data that I have, that is a fact, it has been proven, it exists, it is truth. But any future projections that I'm giving, those have to be given in the form of an opinion. So a stock, let's say, has had 10% return in the last 5 years, and I expect the same to continue for the next 3 years, let's say. The continuation for next 3 years is something that is my opinion. I cannot state that as a fact. So I will have to use the words, I expect the return of 10% to continue, or maybe in my best judgment, the return of 10% should most probably continue for the next 3 years, something like that. So you're not supposed to distinguish clearly between what is a fact and what is an opinion. Also, the communication with the client should be done at regular intervals so that anything you want to communicate, there has to be a regular time interval at which the communications are happening. You cannot have too long a delay between client communications. So that completes 5B. Let's move on to 5C. The last standard we have under standard 5 is 5C, which is record retention. So this is simply talking about all the documentation that you have, you're supposed to retain it. So let's look over the language of the standard. So it is requiring members and candidates to develop and maintain records to support their analysis, recommendation, and action. So basically, any sort of investment and professional work you're doing, any sort of action, analysis, recommendation you are doing, that has to be supported by proper documentation so that you have a justification as to what was the basis on which your recommendation or your decision was taken. So that is developing, maintaining records to support the AI. Aside from this, you are also supposed to develop and maintain records to support all the communications you've had with the clients and prospective clients. So basically, I'm supposed to have documentation proof of all the analysis work that I've done so that I can justify that my analysis was done on the basis of proper information. And I should also have documentation proof for all the communications with clients and prospective clients. Now, aside from this, there are two small complications that have been provided in the standard. The first of those is talking about a case where a member or a candidate has decided to change his employment. So if he decides to go work at a new firm, at a new employer, he might often be, analyzing the same companies that he did in his past firm. The standard is simply saying that you are supposed to recreate your past analysis, but you can only use the information which is public, which is available in the public domain to everyone. Plus, you can only use information that is available to you within your new firm. So you're not supposed to use any sort of information or use your memory to recollect the entire information that you had used at your past firm. So if you use public data and combine it with information that you have received from your new firm, that is all that you can use to recreate any of your past analysis. If you do that, you won't be in violation of the standard. But if you end up using some sort of data or some memory to recollect the analysis or models that you had in your previous employment, that would be a violation of the standard. Aside from that, one small complication is, I'm supposed to retain the records, but for how long? Well, the standard is simply saying that you have to follow your country's local laws in terms of that. In case the local laws are mute about the issue as to how many years the records are supposed to be retained for, then the standard is recommending a minimum tenure of 7 years. Mind you, that 7 years is only and only when your local laws are silent on the matter. So if I have local laws that require records to be retained for, let's say, 2 years, then that 2 years is what I'm supposed to follow. So 7 is not the minimum guideline. It is there only and only when the local laws of the country are silent. So first preference would always go to the local laws, irrespective of what they say. If they are silent on the matter, then the standard takes precedence by recommending minimum of 7 years of holding period. So hope that clarifies. That completes standard 5C, and with that, standard 5 as well. So within standard 6, we first have 6A, which is disclosure of conflicts. So the standard is simply requiring you as a member or candidate to make full and fair disclosure of matters that could reasonably impact. Again, the word reasonably has been used, so there is a subjective element that could reasonably impact your independence and objectivity or your duties to clients, prospective clients, and employers. Now, there are certain important elements within the standard. First of that being independence and objectivity. We had this as a separate standard as well under 1B. Over there, we had a small discussion that, any gift, benefit, compensation, so on and so forth, that competes, or rather that could reasonably expected to impair my independence and objectivity when I'm doing my professional activities, professional work. That would create a conflict of interest. This standard is not talking about situations that would create a conflict. Rather, it is talking about that once I know that there is a conflict, how I am supposed to disclose the same. So, standard 1B is talking about how to identify if there is a conflict or not. Standard 6A is talking about that once you've identified it, how do you disclose the same? And mind you, disclosure of conflict is talking about both actual conflicts and potential conflicts as well. So if you believe some situation is existing today that is not a conflict, but it may turn into a conflict of interest in the future, even that has to be disclosed to be compliant with the standard. Now, after independence and objectivity, we have anything that could compete with my duty to clients, prospective clients, and employers. Specific to employers, we had one more standard, standard 4B, which was additional compensation arrangements. That also had similar language to 1B, where receiving any sort of gift, benefit, compensation, consideration that could compete with my employer's interest, that would also create a conflict of interest. Now, again, this standard 4B, this is talking about identifying whether there is a conflict of interest or not. Once you've identified, 6A is talking about how to disclose it. So there should be a clear distinction in your mind as to what 1B, 4B, and 6A are talking about. Aside from that, one other part that needs to be discussed is specific to these two. Now, both of them have similar languages that you receive any gift, benefit, compensation, all of that stuff. But 1B is talking about that compensation competing with your independence and objectivity. So that compensation gives you an incentive to give a biased judgment, to no longer be objective, to no longer have independence, that would be covered in 1B. But if that same compensation competes with the salary that you are drawing out of your employment, that your employer is paying for your skills, if that outside compensation is competing with that salary, then it would be a violation of 4B. So you need to be able to identify in the exam as to whether a payment or whether a compensation is competing with my independence and objectivity, or is it competing with the salary that my employer is paying for my skills. Once you identify that, you can then check for further details whether there is a conflict or not. So it is very important in exam. This is one of the trickier parts of ethics, where situation across three standards is more or less similar, and at times students get confused in this. But you need to be able to identify what situation would fall under 1B, what would fall under 4B, and what would fall under 6A. So these two standards talking about identifying whether there is a conflict that exists or not. 6A talking about disclosure. And within these, if the conflict is between my independence and objectivity, then it is 1B. But if the conflict is with the salary that I draw, that would be 4B. Now, the last part of the standard is simply talking about that all the disclosures that I make, they have to be prominent, they have to be delivered in plain language, and they have to be effective. So effective simply means that they should convey the purpose, they should make the people who read them aware of the conflict of interest. And plain language is simply indicating that your disclosure should not have too much technical jargon so that your disclosure is not understood by the audience in the first place. I want my disclosure to be plain and simple in terms of its language so that everyone who reads it understands the conflict of interest that I have. Now, there can be certain common examples of disclosures that are made. If you go to some financial news channels, CNBC or something else, you would often find analysts recommending certain stocks and investment to the public at large. Now, at the end of that recommendation, there is often a disclosure as to whether or not they hold that particular security in their own account, or some client accounts or some beneficiary accounts. So that disclosure is again an example of disclosure of conflicts. Aside from that, holding any sort of board member's position in any company could also create a potential conflict of interest. That disclosure would also be done under 6A. So that completes 6A. Let's move on. Next up, we have standard 6B, which is priority of transactions. So this is talking about, as a member or a professional, you might be in a situation where you have to execute certain transactions on behalf of various parties, and you could also be, having some transactions of your own. So the standard is simply giving you a priority to be followed in that case. So the top priority comes to transactions which are to be done for or on behalf of the client. So client transactions take the first priority. The next is the transactions for the benefit of employers. So any sort of investment transaction which is going to end up benefiting the employer, or it is for the employer's account, that have to be given second priority. And the last priority comes to any sort of transaction which is for your own personal interest. Now, these are all talking about investment transactions, mind you. Now, when we have this term personal transactions, the standard also includes any sort of accounts in which you are the beneficial owner. So beneficial ownership simply means, let's say I have an investment account in the name of my mom. Now, she doesn't operate that account. I operate it on her behalf, but any sort of gains that accrue on that account, I have control over those gains. So the account might be in her name, but I am the beneficial owner of it. So this standard, when it says personal transactions, it also includes beneficial ownership accounts, and those would also be treated at par with personal transactions. So even they are supposed to be given last priority. Now, it should be noted that this standard at no point is prohibiting you from taking on personal transactions. Rather, it is simply giving you a chain of priority. So you are allowed to take on personal transactions once you have given your clients and employers adequate opportunity to act on whatever analysis recommendation that you have given. So once they have been given a reasonable and adequate opportunity to act on it, after that, you can take your personal transactions. So at no point is the standard prohibiting personal transactions. Rather, it is simply laying out a sequence of priority. Now, there can be one complication with this standard, which is what if, I work for a firm and some of my family members have an account with that firm, and those family members are also paying the same fees as any other client out there. Now, again, the decision comes to whether or not it's a beneficial ownership of me or not. Now, in general, if the same fees is being charged by the family accounts as is being charged by any outsider client, generally our assumption is that those family accounts are not making me as the beneficial owner. Now, with regards to these accounts, I'm supposed to treat them at par with all my other client accounts, which means that if I have some family members who have accounts with my firm, with my company or whatever, I'm not supposed to disadvantage them simply because they have some sort of family relation. If they are proper fee paying accounts, I'm supposed to treat them at par with all the other fee paying accounts. So those family accounts would then be given top priority with all the other clients, and they won't be given the last priority under the beneficial ownership. So make sure you're able to distinguish whether a family account is, fee paying and to be treated at par with client accounts, or it is to be treated at par with personal accounts. Aside from this, the last element that the standard is focusing on is that often at times, in working at a job, you might be aware of certain trades that your company is about to make. So let's say you have given an analysis, you did your research work, you gave a recommendation, and you know that the next day when the market opens, the company is going to buy a lot of shares for various of the clients and for its own account. Simply the knowledge that the company is going to execute some trades, you cannot even use that knowledge. So having knowledge about pending trades and using that for personal gain is also going to be a violation of the standard. So you're not even supposed to act on the knowledge of any pending trades. So that completes standard 6B, priority of transactions. Let's move on to the last standard, the standard 6, which is 6C. Standard 6C is talking about referral fees. Now, referral fees, let's understand what exactly this is. If you've been using some of the modern apps and services, Uber or some food ordering services like Swiggy, Zomato, or anything like that, you'll generally see a section where you have some sort of a referral code. Now, that referral code can be used to, invite your friends and other people to use the services of the app. And in case your friends who have used your referral code, they decide to join the app, they often get some benefits, plus you get some sort of cashback or a ride if in case of Uber or something like that. That free ride or cashback that you receive, that is nothing but referral fees. Some compensation that you have received, some benefit you have received for referring the services of a particular app to more people, to your friends and stuff. So this standard is talking about the same referral fees. Now, in financial and investment activities, we often have stockbrokers and dealers who often try to have some sort of a referral fees where if I am using a particular stockbroker, he would give me a referral fees and suggest that if I invite more people onto his brokerage services, he might pay me some sort of a benefit, some portion of whatever brokerage is charged on my referrals accounts. So that entire benefit is referral fees. Now, there is no restriction on having some sort of a referral fees, on receiving some fees. The only requirement that the standard is putting is you have to disclose it to the employer, clients, and prospective clients, all the referral benefits that you receive for recommending any products or services. So if I'm recommending my client open a brokerage account with a particular broker, because that broker is giving me referral fees, I simply have to disclose the fact that I will be earning the referral fees to my client. That is all the standard is saying. So make all the disclosures of referral fees that you would be earning so that the client is in a position to judge for himself whether my decision of recommending a particular brokerage services, is it biased due to that referral service or not. So the standard is not prohibiting referral fees. It is simply saying disclose it to employers, clients, prospective clients beforehand so that they are able to make an informed decision whether that referral fees is simply a small amount, or is it something major that is influencing my decision making. So that is all about standard 6C. That completes standard 6 as well. Let's move on to standard 7. So last standard that we have is responsibility as a CFA Institute member or a candidate of CFA Institute. So let's look over that. I haven't written the detailed language of these standards because my suggestion is that you do give your official curriculum one read, because there are going to be smaller nuances that you might want to be aware of in the exam. There are very basic differences. So, just for the sake of example, let's say CFA designation. A person who holds a CFA charter can use the term CFA, but he can use that term CFA after his name and not before his name. So there are such, minor nuances which are very easy to understand, but in the exam, if you are aware of them, that could be a difference between, getting a couple of questions correct and not getting them correct. So I would strongly suggest that you do give your official, curriculum ebook one read at least, regards to standard 7. Aside from that, let's have a quick discussion about 7A and 7B. So standard 7A is talking about your conduct as a participant in any of the CFA Institute programs. So, not just CFA, but any program that is conducted by CFA Institute, you have to make sure that your conduct in the program, your actions, they uphold the integrity of the profession, of the institute, of the program that you are participating in. At no point should you, take any actions that tarnish the integrity of the institute or the programs. So your CFA exams are also covered here. So, violating any of the exam policies would also be a violation of standard 7A. So similarly, you have different institute programs. All of them have their own rules, policies. You're supposed to comply with all of them to be in compliance with standard 7A. Then 7B is talking about reference to CFA institute, the designation and the program. So, various occasions might occur where you have to use the CFA designation. How exactly are you supposed to use it? The valid ways for the candidates are to use CFA level 1 candidate, level 2 candidate, and level 3 candidate respectively. Normally using any other format of, showing that you have cleared a particular exam or you are due to appear in an exam would generally be a violation of the standard. So there are set rules as to how to use CFA designation. Similarly, there is set rules as to how you refer to the CFA institute. Now, there are two specific complications with regard to standards 7A and 7B that I would like to discuss. So with regards to 7A, the CFA institute programs, rules and regulations, they are supposed to be followed. Now, at no point does the CFA Institute restrict you from expressing your opinion. So simply expressing your opinion about CFA Institute programs is not a violation of the standard. The thing that is restricted is that you are not supposed to reveal any of the confidential information about any CFA Institute program. So as long as you are simply expressing your opinion, you are not violating the standard. But if you express or disclose any of the confidential information, then you would be in the violation of the exam. So let's take your CFA exam. Simply saying that the exam was tough or easy, it is fine. Discussing or disclosing specific questions that were asked in the exam, that would be a violation of the standard. Now, the specific complication that I want to discuss with regards to standard 7B is that institute is clearly specifying that at no point should you be trying to exaggerate the meaning of the CFA designation. So saying that I have CFA designation doesn't imply that I would be able to have superior investment analysis, recommendation, and actions than anyone out there who is not a CFA. So claiming to be superior on the basis of being a CFA, that is not allowed. So exaggerating the meaning of the designation is not going to be permitted, and that would be a violation of the standard. Another case of this could be, clarifying between what is a fact and opinion again, but in context of CFA designation. So maybe you have cleared your exam in the future and you cleared it in the first attempt. So simply saying that I have cleared my exam or I've cleared it in the first attempt, that is something that is true, that's a fact, that is fine. But claiming that because you have cleared it in the first attempt makes you superior than anyone else who hasn't, that would be a violation of the standard, because now you're trying to exaggerate the meaning of the CFA designation. So that are the two complications specific to these standards that I wanted to cover. So very basic, and I would strongly suggest give your curriculum ebook just one read. You'll know a lot of smaller nuances that, if I end up covering in the class, it could take an hour or so. So just give the ebook a read. You have any doubts, you can always contact me for that. That completes our standards and the entire reading 3. We have 2 more readings left in ethics, so let's continue on with that. Now, the very last topic that we have in the course for ethics is GIPS, the Global Investment Performance Standards. So you have 2 readings for that, reading 4 and 5, and generally GIPS as a topic as a whole, both readings combined, At level 1, it is at a very introductory and basic level. In fact, the detail GIPS as a topic is part of CFA level 3 curriculum. So at level 1, your purpose of reading through this material is simply to get an understanding as to what GIPS is, why do we need it, why does it exist, and some basic provisions that are relevant when the firm decides to apply GIPS. So let's start with why exactly do we need it? Now the question is, why exactly do we need GIPS? Well, in the very basic sense, GIPS is nothing but ethics for presentation purposes. So basically, investment performance is, let's say I have a wealth management firm. I have certain client accounts. At the end of the year, what I do is I gather the data from all the client accounts and I'm presenting a performance that represents me or my firm. Like, this is what the performance of our firm is. That is what the investment performance means. Now, the reason why we need some sort of a standard for that is because there were certain biases that existed. So let's look at some biases. Now, the reason why we need to study biases in a little bit more detail is because when I look at myself as a potential investor, I'm looking at various investment firms. Now, I need to be able to, have some sort of reliability in terms of the performance that those firms are reporting. At times, without the standards, the performance that is reported by the firms. Now, at times, what happens is that investment firms are registered as partnerships and not as companies, which means companies normally are subject to more disclosure requirements, partnership firms are not. So, another need for GIPS is that if I have a lot of partnership firms, I need to be able to make sure that their performance is also complying to a particular standard so that I can make them comparable. Now let's look at these biases in a little more detail. First of all, we have representative accounts. This is a specific case when an investment management firm, when it decides to present performance of its investments for, let's say, last 2 years, 3 years, 5 years, it decides to include only and only the topmost performing accounts. So only top performers. So what I'm doing here is I am cherry picking some of the most efficient and the best performing accounts that I have managed in the last few years, and I'm using them as a benchmark to report my investment performance. So obviously that would create an upward bias where the performance I'm reporting is higher than what on average I'm able to achieve, because my reports are only including my best performing accounts. Survivorship bias is sort of similar to representative, but not exactly similar. So survivorship bias is excluding weak performers. Now, a lot of you might think both of them are more or less same. There is a very small difference. Let's say I have 10 accounts, 3 of those are top performers, 2 of those are worst, 5 are more or less in the middle. When I use representative accounts, I'm only picking the 3 which are the best. But when I have survivorship bias, I am excluding the 2 which were worst and the other 8 are still part of my sample. So in survivorship bias, if I exclude the weak ones, most of the average ones, middle of the pack accounts and the best accounts, those are still part of my sample, that which I will be reporting. So there is a small difference between these two, but both of them would have some sort of an upward bias where the returns that I am providing to my clients might seem higher than what on average I actually am able to achieve. Lastly, we have time period bias where, as I said, most of the firms are registered at partnerships, so they don't have any legal requirement to comply with in terms of disclosures and reporting. So it is possible that, some firms are having quarterly investment performance reports. Some might have annual. Now, it creates a distinction for me where I'm not able to get the same time period done. In fact, there is no requirement to make sure that a firm that is reporting quarterly uh, performance doesn't all of a sudden switch to an annual performance. So the time period could often be biased. I might have a situation where the analysis is done just for the last 2 years. Sometimes the analysis could be done for last 10 years. So all of those situations where the time period of two matching or two comparable entities, two comparable situations doesn't quite add up, that is when I have time period bias. Now, because all of these biases existed, I needed some sort of a global standard to, remove these biases and to bring all the performances at some sort of a par level. So one reason is to deal with the biases. The other reason is to bring uniformity. And with uniformity, comparability as well. Now, once I have corrected for the biases, now the second part is, we've discussed in the ethics as well, that trust is very important in the investment profession. So how do I build trust? For that, I need to make sure that the information that investment firms are reporting is very reliable, it is trustworthy. Another thing I need to make sure is that different investment firms can now be compared with each other. So if they are reporting according to the same standard, just like accountancy. In accountancy, we have accounting standards, and because all the companies comply with those standards, their finances are same. Everyone is preparing balance sheet with more or less the same format. Same thing for income statement, same thing for cash flow, so on and so forth. So the major requirement for GIPS is that it brings uniformity to how investment performance is reported, and it also makes comparisons possible between different firms so that an investor can make a more informed decision as to which firm would be better suited for his requirements. So that is the discussion as to why do we need GIPS. The compliance with GIPS is not mandatory outright. In fact, it is voluntary, and the firms, if they want to comply with GIPS, they can go through an independent verification process and claim compliance with the GIPS. Now, we'll discuss the verification part a little later. Right now, with regards to GIPS, there are two particular terms that are often repeated. So let's discuss those. Now, GIPS compliance can be claimed on a firm-wide basis. Now, the word is firm, which means whatever my firm is, we'll discuss what that is, but whatever my firm is, 100% of it has to comply with GIPS for me to claim compliance with GIPS. So I cannot have a situation where only one part of my firm is complying with GIPS. I need to have my entire firm complying with GIPS. Now, what exactly does the meaning of the word firm is? So the firm in this context means the distinct business entity that you are holding out to the public. So if the public knows my investment operations are happening under a particular name, that brand name and all the operations under that brand name would together become a firm. For the exam purposes and for the company as well, the recommendation from the GIPS is to include the largest possible definition of the firm. So if you think there are smaller entities that could be supporting a bigger entity, try to include those as well within the purview of the word firm, so that when you claim compliance with GIPS, you are claiming it on the entire firm. Now, the other word that is repeated often is composite. Composite has a very set definition. Now, the official definition of composite is that it includes all discretionary fee-paying accounts which have, similar investment strategy. The objective of investment is same in all of those accounts. The mandate is more or less the same. So let's discuss the term discretionary. Now, discretionary word simply means whether the firm, whether the investment manager has some sort of discretion, has some sort of right and freedom to take decisions on behalf of clients. So I'm including all discretionary fee-paying accounts. So having any account which does not have any sort of fee attached to it, that will not be part of the composite. So composite is all discretionary fee-paying accounts. And the second condition is those accounts need to have similar objectives, mandates, or investment strategies. Now, the reason why understanding what composite is relevant is because the definition uses the word all. Now, if you notice, we discussed a few minutes before that there were certain biases. Now, if I'm including all the accounts that have similar strategies or mandates, a lot of the biases would be taken away. Now, if I'm creating a composite that includes all accounts, some weak performers might also be included, some best performers might also be included. So the results that I finally get would be more or less averaged out. Now, the reports and the performance that I'm supposed to give under GIPS has to be on a composite basis. So I cannot report separate accounts. I have to construct composites, and then I'll report on those composites. And the compliance for GIPS can be claimed firm-wide. Now, aside from these, there is also a verification process. Now, as we discussed, complying with GIPS is voluntary for the company. If they want, they can claim the compliance with GIPS, else they can continue reporting however they are. But claiming compliance with something that is globally accepted standard would create more trust within the investment community, within the investors, to be dealing with that particular investment firm. Now, one of the ways or one of the methods in which you can claim that your firm complies with GIPS is by having a verification. Now, this verification, you can think of it very similar to something like an audit. I would have an independent third party come in. They would then review whether I have applied GIPS on the entire firm-wide basis. They would also review whether the composites that I'm using have they been constructed correctly, or is there any sort of error in construction of the composites itself? And all the other requirements of the GIPS would be checked by that independent third party. That third party would then verify and say that, okay, yes, you comply with all the requirements. Now you can claim compliance with the GIPS. So verification, if you want to claim compliance with GIPS, it has to be mandatorily done by an independent third party. So that is the discussion about firm, composites, and verification. Let's now move on to the discussion as to how exactly can I claim compliance with GIPS. Now, once we have a basic idea as to what a firm is, what verification is, how a composite is constructed, the next step of discussion is how exactly does a firm comply, or rather claim the compliance with GIPS. So we have two conditions, both of them have to be satisfied. And there are certain cases which we'll discuss, after going over these using certain timelines. So the first condition is saying that in order to claim compliance with GIPS, you are supposed to restate either past 5 years or all the years since inception. We'll discuss both these cases in detail with timelines. So you are supposed to restate all of this presentation data according to GIPS. So any of the past data that you have, which is not complying with GIPS, you are supposed to restate it in such a way that it now complies with GIPS. And the second condition is, so the first condition will allow you to start claiming compliance with GIPS. So once you do the first one, you can now claim that you are complying with GIPS. But the second part of the equation is that, okay, once you've claimed the compliance, how do you maintain the compliance? I don't want next year to all of a sudden not be GIPS compliant. So in order to maintain the compliance, we have second condition, which is saying that once you've done the past 5 years or the past data has been corrected, continue adding GIPS compliant performance data till there is a minimum of 10 years of compliant data. So I had done past 5 years. Now I'm supposed to keep adding data on it in the future periods such that I have a total GIPS compliant data of at least 10 years. In order to understand these better, let's look at timelines. Now let's look at this timeline. Let's say there is an investment firm that was started all the way back in 2010. Now, just for the sake of simplicity, I'm not going to put dates in to confuse you as to how many years there are, but simply know you have to comply with 5 years and 10 years of requirement. So let's say a firm started its operations back in 2010. Now we have 2020. Let's say in 2020, right now, the company or the firm wants to claim compliance with GIPS here, which means they now want to start claiming to the public that yes, our performance data complies with GIPS. Now, the first condition said they had to restate past 5 years of data such that these 5 years represent the data that complies with GIPS. So they would state these 5 years of data into GIPS compliant formats. Now, once you've done that, in 2020, they can claim that yes, we comply with GIPS. But in next year, they will also have to, or rather, they would also prefer to still comply with GIPS. So, in order to maintain the compliance, the standard is simply saying next year, let's say 2021, I have one more year of data. I'm supposed to add it. Then I'm supposed to do the same for the future, 2022, so on, all the way till 2025. At this point, now I have a total of 10 years of data which complies with GIPS. So what has eventually happened is I first restated last 5 years, and then every year I'll keep adding new performance data which complies with GIPS for so long as I have a total of 10 years of data that is now complying with GIPS. The second condition said minimum of 10 years. So now that I have 10 years of data, the company has two options. Both would be perfectly fine with GIPS. So there is no violation of GIPS in either method. It is at the discretion of the company. The first method is, let's say they have one more year of operations. The first approach is they simply add this to the previous data, and now in 2026, they show 11 years of data that complies with GIPS. Perfectly fine. The other alternative is they add this 1 year's data and they remove this 1 year's data. So what they'll do is they'll again have a total of 10 years, but they'll keep adding new data and they'll keep removing the oldest data. So the data for 2015-16, that would be taken out of my GIPS compliant performance data, and this new one would be added, such that the second condition is still being satisfied where I have a minimum of 10 years of data that complies with GIPS. So either of these last two options that a firm or a company can follow, both would be fine. Both are acceptable within the purview of GIPS. Now, the one other case that we need to discuss is, what if the company has been in inception for less than 5 years? What if it's a new firm? So let's make a separate timeline for that. Now, let's say I have a new firm that was started in 2018, and right now in 2020, this firm wants to claim compliance with GIPS. Now, if we take the condition of 5 years, this firm doesn't have 5 years of data to restate in GIPS format. So the standard is simply saying that in case your company has been in incorporation and inception for less than 5 years, simply restate all the data that you have since inception into GIPS compliant format. So in this case, I'm simply supposed to restate these 2 years of my performance data to now be compliant with GIPS. Once I do that, first condition is satisfied, which means in 2020, I can claim compliance with GIPS. The second condition still holds true, which is now to maintain the compliance, I'm supposed to keep adding data such that the total data that I have compliant with GIPS is a minimum of 10 years, which means every year they will keep adding more performance data all the way till 2028. So now in 2028, they have 10 years of performance data that complies with GIPS. Beyond that, the same options that this firm had, they will also have, where if they want, in the next year, they can add more data and make it 11 years of data that complies with GIPS, or they can add 2029 data and remove this 1 year so that they still comply with the minimum 10-year condition of GIPS. So I hope these two timelines have clarified those two conditions. Those two conditions are relatively important from the exam perspective. Now, at times, it is possible that, let's say I'm operating in India and there are certain regulators who require me to present the performance data in a particular format. Now that format is more or less same as GIPS. So my country has its own version of laws, rules, regulations that are trying to replicate what the GIPS is trying to replicate. Now in that case, the general requirement is that if you want your performance data which you have prepared in compliance with your country's version of GIPS, you can claim compliance with the GIPS based on this version. So you don't have to restate it, you can simply use this as it is. But now this condition is only applicable if the country version of GIPS compliant data pertains to years before 1st January 2006. So this date is what makes this provision a little less relevant in the practical sense, but it is still part of your syllabus. So if you want to present information prior to 1st January 2006 in GIPS compliant format, the GIPS is simply saying if you followed your country's version of GIPS, you can use that data as it is. So I hope that clarifies. Let's move on to the next topic. Now, the last section that we have in our entire CFA ethics curriculum for level 1 is talking about the major sections of GIPS. Now, as I've said before, GIPS as a whole is a more broader and detailed topic at CFA level 3. At level 1, your purpose of understanding GIPS is to simply know that there is a performance standard and to know some basic requirements and definitions as given in the same. So these 9 sections, you only need to be having a basic understanding as to what these 9 are. That's it. The details of what they cover is not part of the level 1's syllabus. And in case some of you are curious as to how these GIPS are or what the possible details could be, I'll have the GIPS website linked in the video description. You can check that out. Now the 9 sections, remember the numbering starts from 0 and ends at 8. So a lot of students, often ignore the numbering and they think it's 8 sections. It's actually 9 sections. Now in your exam, there is a good chance, any sort of testing that comes from this 9 sections is probably going to be of the questions asking, simply which of the following is least likely a major section of GIPS or which of the following is most likely a major section of GIPS. So you don't have to cram these. You definitely don't need to be cramming these with numbers. All you need to know is what the 9 elements are, so that in case you get 3 options, you should be able to identify out of those options which is part of the major sections and which is not part of the major sections. So first is the fundamentals of compliance. We have very basic details as to what the firm would be, how the compliance can be claimed, all of that stuff. Then we have input data, so any sort of analysis or presentation work that you're giving, what all inputs you can have and how you should make sure that your inputs don't have any sort of bias in them. Then you have calculation methodologies, composite construction, disclosures, and finally presentation and reporting. The last 3 elements pertain to specific sets of investment or specific sets of assets. So real estate, private equity, and separately managed accounts. All of these have their own unique features and slightly unique guidelines according to GIPS. So details, again, not relevant for CFA level 1. You simply need to know that there are 9 sections, and in a question, you should be able to identify whether something is part of these 9 or something is not part of these 9. So that completes GIPS, and with that, we are also done with ethics for CFA level 1. I hope you enjoyed the content and see you again. Hi guys, so hopefully you did like that video, found it informative. If you have any sort of doubts about the content we covered in this class or in any other session, or in general about syllabus or anything else you might need my help for, you can contact me. The details are here. And I'll link these same details in the video description as well. So see you in the next one.